Yeah, I mean, I think the economy's sort of bumping along, just sort of early phases of a recovery. I think some of the numbers that have come out over the last 6 months have been pretty positive. I think you have to separate London and the regions into just two completely different real estate markets, at least. London, incredibly vibrant, the amount of capital flowing, the amount of development activity starting up, just the, generally speaking, it looks more like a global city as it should than, a UK city. You go in the regions, I think, there's a few interesting kind of trends. There's a lot of displacement of capital out of London now. I don't think UK institutions can afford to buy anything in London anymore. And so we're certainly seeing on things that we own, the number of off-market approaches to buy assets that we own, that we've owned for the last 2 or 3 years in sort of non-Southeast UK has gone up exponentially over the last couple of months.
Oh, has it?
I just think people have they've renewed their appetite for the regions. Again, I think that's more a displacement of capital effect from London than it necessarily is a recovery in occupied demand. But I think, we have seen some sort of tentative signs of recoveries in the office market. Retail, I think, is just kind of an interesting one. We've been pretty active in the retail market over the last 2 years. We've bought a lot of retail. We've bought it from institutions who perceive a huge amount of structural and cyclical risk. And in some cases, I think the reality is that an awful lot of what they perceive doesn't play out when you apply capital to the asset. So if you can buy a building, you can inject capital into it. I think there are tenants that will occupy it. They'll pay decent rents. And I'm pleasantly surprised. A lot of what we own, we are doing better than business plan, leasing more space than we thought we would at higher rent levels with lower TI packages. But I think a lot of that is about where you buy it and what you're able to underwrite it at. Our weighted average entry point on the retail that we own is about a 9.5% yield. So I think if you can buy it for £75, £80 a foot, off rents that are way, way below where they were at the peak of the last cycle, you can pull schemes back up that a lot of institutional investors will have been very worried about. But it's all about your basis. If you buy it cheap enough and inject capital into it, I think you can bring it round. And to that extent, I think you've started to see other people starting to do things like that. But I'm not, I think the regions are getting back, and I'm not as bearish on retail, and we haven't been as bearish on retail as the market has been over the last couple of years. Because I don't think we've been willing to conflate secular and cyclical. We've been willing to try and separate the two and think about them and figure out whether or not what we own is economically viable at a low basis. If you can do that, I think there's things you can do there.
Okay, good. And the interest that's coming off market, let's say for the secondary assets, is that from a particular source, or is that private equity money? Is it?
It's a mixture of people. There's some public company money. There's some. I don't think there's too many private equity people trying. We don't like to self-cannibalise each other. We don't like to buy off each other. So, generally speaking, it's if we've advanced our business plan, most of the off-market stuff comes from, we know you own this, we can see that you've advanced your business plan because the building is more leased than it was when you bought it. There's still something to do, which I now see as upside rather than risk. Could I possibly buy that for you at a much more aggressive yield than you paid for it, please?
Okay.
And that's UK institutions, generally speaking, and probably a little bit of public company money as well.
I think looking at the UK, we have a little bit to differentiate from the investor base we were having. We have a lot of investors that simply demand us to hedge currency risk in the existing funds we're operating. And every time you have to do that and then look at the UK market, you're not that competitive in bidding on the building. So you have an additional cost to work on. On the other side, having said this, we're also having a couple of investors that don't demand us to hedge the currency risk, where they try it in an overlay on their portfolio. So we care more about the fundamentals. And I would say, yes, we did a lot of looking at the regions, but only on assets where we can extract potential via asset management, releasing and repositioning. So that's a little bit of the story we have done. Our UK guys that have done in the past, and we are currently also looking and trying to get some assets. But I think the competition is different to what it was 6-8 months ago. A lot of more institutional investors are finding this an attractive idea and looking out in the market. So the pricing on a lot of these assets for us reached a level where we say maybe it's not worthwhile really for the yield requirements we're having with the products to really bid on the assets anymore. So I think it's getting quite competitive in most of these markets again already.